Greetings, everyone! Today, we're focusing on the substantial updates brought to you by the One Big Beautiful Bill, which makes significant changes to tax benefits and incentives. With enhancements aimed at both workers and seniors, the new law provides opportunities for expanded deductions that can provide financial relief in these transformative 2025 tax filings. It introduces increased caps on various deductions, along with new categories that empower you to claim more while ensuring you stay compliant. Let's break down the key changes to ensure you're well-informed and ready for the upcoming tax season. The One Big Beautiful Bill, signed into law on July 4, 2025, has redefined the landscape of personal finance. It introduces extended tax rates and substantial deductions, aiming to ease the burdens of taxpayers across the board. As we navigate these changes, it's crucial to understand how they affect both your current financial situation and your future planning. Every detail matters, so let's focus on how you can best leverage these new provisions to your advantage. Whether you find yourself filing jointly or as a single filer, the adjustments outlined in this legislation will have a direct impact on your tax filings. Stay with us as we examine these reforms in detail. The detailed implications of the standard deduction boost are pivotal. For single filers, the deduction increases by $750, raising it to approximately $14,950. This change not only simplifies your tax return process, but also alleviates the burden on many taxpayers who would have previously opted for itemizing deductions. As for heads of households, they benefit from a more substantial increase of $1,125, bringing their standard deduction to about $23,025, which means more money in pocket. Moreover, married couples filing jointly see a rise of $1,500, making their new deduction around $31,500. As tax compliance becomes easier, fewer filers may need to delve into itemized deductions unless they come with significant conditions that weigh in their favor. As we transition to the expansion of the SALT deduction, it's essential to highlight that the cap will increase dramatically from the previous $10,000 to a remarkable $40,000 for 2025. This adjustment, which will rise by 1% annually until 2029, provides substantial relief to those living in high-tax areas, allowing them to claim more of what they pay in state and local taxes. For households facing high taxes in states such as New York, California, and New Jersey, this means significant savings on their tax bills. Understanding the income phase-out limits, beginning at $500,000 for modified adjusted gross income, (MAGI), and fully phasing out at $633,333 is crucial. Thus, proper planning is vital for those hovering around this threshold, ensuring they can maximize their SALT deduction benefits before the cap expires in 2030. The introduction of new deductions, specifically for tips and overtime, will be a game changer for many. Workers in the service industry, such as servers and hairstylists, can now deduct qualified tip income, providing them much-needed relief from the previously taxable status of their earnings. This initiative acknowledges the reality of income fluctuations in tip professions, offering potential tax savings that can amount to hundreds of dollars. For overtime earners, these deductions will also apply, meaning hard work can translate into real financial benefits for those putting in extra hours at their jobs. As we embrace these changes, it becomes vital to track earnings closely and maintain accurate records to fully capitalize on these newfound tax advantages. The new auto loan interest deduction marks a significant development for car buyers starting in 2025. This deduction allows taxpayers to deduct interest paid on loans for qualified U.S.-made vehicles, providing relief up to a limit of $10,000 each year. The provision applies only to the interest portion of the auto loan, making it essential to distinguish between principal and interest payments when filing taxes. Additionally, to qualify, the vehicle must be manufactured in the United States, which aligns the incentive with supporting local production. Income restrictions apply, with singles facing phase-outs beginning at $100,000 and couples over $200,000, meaning only those below these thresholds can benefit fully. Planning around this new deduction requires careful documentation of loan details and understanding the vehicle's assembly location to ensure compliance and maximize tax benefits. This strategic approach can lead to notable savings for eligible drivers seeking to invest in American-made vehicles in the coming years. The senior citizen deduction adds further assistance, providing an additional $6,000 deduction for taxpayers age 65 and older, applicable from 2025 to 2028. With income limits set to phase out for individual filers above $75,000 and joint filers over $150,000, this deduction aims to lessen tax burdens, especially as many seniors depend on Social Security benefits. It's crucial to note that this policy impacts over 88% of senior filers, a significant increase from approximately 64% before the law's enactment. This change emphasizes the importance of tax planning for older adults as they might find themselves owing little to no federal tax on their benefits. Seniors should remember to claim this deduction in their 2026 tax preparation to optimize their retirement finances. Planning ahead is essential to navigate these developments effectively. Continuing with the child tax credit updates, families can rejoice as the credit per child increases from $2,000 to a new maximum of $2,200 starting in 2025. This boost in financial support for families comes at a crucial time, potentially easing expenses related to raising children. Additionally, the introduction of the innovative Trump account takes a forward-thinking approach to encourage savings from the moment of birth. With an initial investment of $1,000 and the opportunity for up to $5,000 in annual contributions, this account grows tax-deferred, paving the way for significant long-term benefits in education, job training, and home purchasing. It not only simplifies budgeting for parents, but also adds a layer of financial security that can lead to better opportunities for children as they grow. The merging of these provisions makes a substantial difference in planning for future needs and reinforces the government's commitment to supporting families as they navigate financial responsibilities. Parents should be proactive in registering their babies for these accounts and carefully documenting any contributions each year to fully maximize the benefits available through these new initiatives. As we look at the expiration of certain green energy credits, it's vital to understand the impact these changes will have on both households and businesses. The clean vehicle credits, which offered up to $7,500 for new electric vehicles and $4,000 for used ones, will end on September 30th, 2025. Simultaneously, the residential clean energy credit, which provided a 30% deduction for solar installations, will also cease on December 31st, 2025. These expirations mark a significant shift in federal support for green initiatives, compelling many to act quickly if they plan to invest in electric vehicles or clean energy solutions before these benefits disappear. It's essential for consumers to integrate these timelines into their financial planning, ensuring they take advantage of these credits before they are no longer available. Therefore, if you're considering a purchase, maintain close attention to these deadlines and incorporate them into your 2025 tax strategy. With proactive measures, taxpayers can still leverage these credits, minimizing their tax burdens while supporting a transition to greener energy solutions. Beginning with the sunrise of new tax reforms, let's examine how the sunsetting policies affect taxpayers seeking out these advantageous benefits. As previously mentioned, many of the exciting deductions are set to expire by 2028, which means it's crucial not to lose sight of the time-sensitive nature of these modifications. While the SALT deduction expansion and senior exemption provide necessary relief, the reality of expiration invites careful planning to alleviate fears of a potential fiscal cliff. By adopting a strategic approach to tax preparation now, taxpayers can secure advantages while taking full advantage of the deductions within the next few years. As we wrap up this analysis, it's clear that your awareness and action in these areas can significantly influence your financial outlook. As we transition into the next phase of understanding these reforms, keep in mind the necessity of organizing your records for effective tax planning. An efficient checklist will ensure that you capture all eligible deductions, allowing you to maximize your returns while staying compliant with the law. It's important to remain proactive in tracking any changes in your earnings and tax obligations, as the landscape of personal finance is ever evolving. Being prepared with accurate documentation will not only simplify your filing process, but also empower you to make informed financial decisions in the wake of the One Big Beautiful Bill. The significant amendments presented by the One Big Beautiful Bill demand your attention as you prepare for the tax season. This overwhelming change in tax regulations emphasizes the importance of remaining organized and informed to navigate your financial obligations optimally. By understanding the various deductions and credits available, you can maximize your savings and make the most of this unprecedented opportunity. Careful planning, tracking your income, and acting promptly on these developments will not only enhance your tax filing experience, but also shape your financial future positively. Thank you for joining us, and we look forward to seeing you in our future videos, where we explore more financial insights. As we conclude our exploration of the One Big Beautiful Bill and its transformative impact on your tax filings, remember that proactive planning is critical. By harnessing the available deductions and credits now, you can pave the way for a more secure financial future. Thank you for engaging with us, and take these insights to heart.